Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder. I'm your host and also the host of the Broadcast Retirement Network's BRN AM show. Thanks so much for joining us. We're going to go around the globe today to discuss the issues related to retirement markets, technology, personal finance, so much more with our members of the media, financial services, and academia. So sit back, relax, and enjoy this episode of BRN Sunday. We're going to kick things off with a look at technology this week, and joining me on the line, senior technology reporter and consumer products reporter from The Motley Fool, Daniel Klein. Hey, Daniel, how are you?
I'm good. How are you, Jeff?
I'm doing very well. How's lovely Florida treating you?
We are in the middle of some wonderful weather. It's like high 70s, low 80s during the hottest part of the day. And sadly, I am heading to Seattle.
Well, Seattle's a beautiful part of the country, but I'm not going to feel sorry that you guys have the 70-degree weather. It's about 24, 25 degrees here where I am near New York City. So enjoy that weather, but bring a rain jacket when you go over to Seattle.
I work for Microsoft, so I've spent lots of time out there. Lots of friends, happy to go, but not so thrilled to go this time of year.
Well, anyway, I hope you have a safe travel and it's going to be fun. And just like I said, just bring a hat for your head. Okay, so let's jump into it. Lots going on in tech. We talked a little bit about it this week on the network. But what can you tell us? What's top of mind for you?
Yeah, so you might have seen the story today that Google has made a deal to collect health data on millions of Americans.
Yeah,
Now, on the
that's
posit
reassuring. That's
on the
reassuring.
po- yeah, so on the positive side, this is very similar to what Apple's doing, where they're going to be able to use their technology to aggregate information, which might put together trends. It might uncover things that are beneficial. That's the good part. Maybe they'll cure a disease or figure out something. The negative part, of course, is Google is going to have access to your health information. Now, it's supposed to be aggregate, but as consumers, I think there's a healthy level of skepticism with these big companies having any access to data, especially when we didn't opt in. This is insurance companies sharing the data, I assume for money, without our explicit consent.
Now, how could you do that? I mean, let's be honest. I mean, there's like HIPAA, all these rules, but how could you just collect data from insurance companies, have them sell data on each one of us that they've
So,
collected? Is that
so
possible?
with HIPAA, they have the right to sell aggregate data.
Mm,
And if the problem is mistakes happen.
yeah.
This is one of those where like it's great if Bank of America tells me, and they do, what the trend among their 50 million credit and debit card customers are. So I'll get data from them. Last Christmas, this is what people spent. The biggest spending day was this. The most money on gas was spent this day. That's great. But if they accidentally sent me the underlying data and said, hey, this is Jeff's credit card number, here's what he spent. Boy, there's a couple of questionable things on there.
Nice.
That would be bad. And obviously, they're not going to do that intentionally, but we've seen some history where that happens.
Yeah, I look, I think it's great to be able to. I think we need trend information, but why can't, for example, United Healthcare or one of these other healthcare providers do their own trend analysis and then do a report and share the report, um, like so many organizations do? I mean, why does it have to go to Google? What do
I,
they do that's so special, Daniel?
yeah, I think some of the big tech companies probably do have the ability to do some things with data that a health insurance company can't. And again, if this works as it's supposed to, which so far Apple's has. So
Yeah.
Apple can collect all sorts of data based on what it already knows about you, based on the Apple Watch, based on iPhone, all sorts of movement and it can tell what you're taking, what you're not, lots of interesting things. And in theory, that's going to help with heart disease and other issues. I'm going to focus on the idea that if this goes well, it could be a big positive. But as consumers, we need to be vigilant and not all that forgiving if this goes wrong. There needs to be consequences for when, Joe in IT at the health insurance company accidentally sends your card number out to the masses or whatever it is. We've seen enough credit card breaches that are literally that clumsy to know it can happen.
Yeah. Well, let's be clear. That's going to happen because if it's happened, it's just going to happen because humans are involved and humans make mistakes. So let's be clear that that's going to happen. It happened at Equifax, a big company. It happened with some of the other data breaches in healthcare organizations. So that's going to happen. The question is, how will that be responded to, and how can you as a consumer respond to that if you find out that your data has been breached and pickpocketed?
Yeah, it's just something, again, we talk about this, it seems like every week.
Yeah.
You need to be on top of your data. So if all of a sudden you're getting mail based on something you thought was classified, your status with a particular disease or whether you're pregnant or not, well, then someone has sold your data and you can figure out who. Now, again, you can buy a mailing list that is addresses. You don't see the addresses. You don't get access to the names. That is people that have certain conditions, or just like you can get credit card offers based on your credit score, not really who you are or what you do. So it's very tricky to figure out where this stuff is coming from. And we've all had the experience, and it's kind of freaky, where maybe you and your wife are sitting at the dinner table and you talk about I don't know, a brand of dessert you like, and then all of a sudden you're getting Facebook ads for that particular candy bar or whatever it is. So there's a level here where some of this is out of control, and you have to be as careful as you can, but you don't control it.
No, I think you don't. I think that's something that I was talking to a cybersecurity expert and about this, and actually on the show for an interview on the show. And, I don't think we really anticipated these issues when the internet was born and when consumer over 25 years ago, right, Dan? I mean, these are things that we probably did not contemplate, or if, we didn't look that far ahead.
No, I think when the internet was born, it was largely used to tell people, hey, I have the internet, I have email now, much like the old days of when there were phones on planes, where the primary use was to wow people that you made a call from a plane. So obviously we didn't see how this was going to grow. For a long time, it seemed like the internet was going to be walled silos like AOL, where you're paying access for a very large group of information, but it's not this sort of freewheeling, all this stuff out there. We're also in, it might be day 2 of the internet in terms of how much this is going to evolve and how we communicate. Augmented reality, virtual reality, that stuff's going to come into play. I don't think we're too far off of the day where your meetings are held in a virtual boardroom and you're all wearing headsets. Now, to do that, what do they have to do? They have to make the headsets lighter. I have an Oculus Go, and it can do that. It just, you wouldn't want to sit through a 45-minute meeting wearing an Oculus Go in your head. So some of this security has to be baked in, and you're starting to see it with credit cards. There is more security. A chip card is more secure than a regular card. Two-factor authentication when you log into something might be a pain in the ass, but it works, and it's definitely safer. So, this stuff is going to fix itself, but we do as consumers have to sort of keep an eye on big companies and what they're doing with our information.
Yeah, actually something to be very thoughtful about, mindful. And I think we cannot talk about this issue enough, whether it's here on the podcast or talk about it on the network. So I applaud you and appreciate you doing that. So let's shift gears. I know you also want to talk about WeWork. Sounds like there's potentially a new CEO.
Yeah, so WeWork is a dreadful company. WeWork is a company, a dreadfully run company. It's a cool product.
Yeah.
So they're co-working spaces, and I work in a co-working space. It's locally owned. It's not a chain, but WeWork is a chain of them. So essentially, they're a real estate company that gets the real estate, outfits it with everything from private offices to shared working spaces to hot desks where you rent the access to a desk but not a specific desk, to specific desk, meeting rooms. It's sort of an all-in-one office solution at different price points. So you would think that's a pretty good model. If you could, if you could get a space, fill it with people, they're going to pay more per person than like a company would to rent a comparable amount of space. It should be a very profitable model. And the reality is WeWork has been losing billions of dollars, and it was supposed to IPO, and it didn't, because when people got a real look at the financials and sort of some of the shenanigans they were paying, the former CEO, founder, was getting paid for like licensing back the name to the company and a lot of really shady stuff. So he was pushed out, and the company has sort of an acting interim CEO situation. And SoftBank, which sort of bailed the company out and is the majority holder, they've actually been talking to potential CEOs, one of whom is John Legere, the CEO of T-Mobile. And what makes this interesting, besides that he is a dynamic CEO who I would trust running any company, is that he's the CEO of T-Mobile, which is merging with Sprint, and SoftBank is the majority shareholder in Sprint, and they will become the minority shareholder in the combined T-Mobile. So while there's no guarantee that Ledger takes the job or really any signs about how serious he is, this shows you sort of the depth of concern at SoftBank, where they're willing to take the CEO, who has been the only one who's been able to compete with AT&T and Verizon, take him away from T-Mobile and move him to WeWork. Now, it is possible he ends up in some sort of shared situation. Maybe he becomes the chairman of T-Mobile and the CEO of WeWork. But I think this is sort of a very interesting developing story that's not so great if you're a T-Mobile fan.
Yeah, I mean, does that water down? I mean, how can you be in two places at once? And I know Steve Jobs managed both Pixar and Apple, right? Or Next
Yeah,
and Pixar.
Jack Dorsey is the CEO of Twitter and Square, so there is some precedent for it. I'd be surprised. The only reason a John Ledger would go to WeWork is either that he loves a challenge, and it is a challenge, or that there is so much money and equity being thrown at him. But I do find it odd that SoftBank would be willing to kind of undermine what is still a very sizable investment facing a difficult challenge. So unless there's something we don't know, maybe Mike Sievert, the president COO of T-Mobile, has job offers and is ready to leave, and they're trying to find solutions to keep everybody happy.
Yeah.
But this seems like a very strange one because yes, WeWork is a major turnaround job, but it's really about cost control, whereas T-Mobile is managing a massive capital infrastructure with building out 5G and taking on two absolute titans in AT&T and Verizon.
Well, I guess this gentleman is up for the challenge, and I guess we'll see. I did read somewhere that the WeWork valuation was like in the $40 billion, and it was like dropped to like 8 billion. Did I get those numbers right?
Yeah, it's like somewhere between 40 and 8 to 10. So this is one of those, and I will give journalists, analysts, media credit. We have had a few IPOs recently. One I cannot mention because of family ties to the company, but we've had a couple of almost IPOs that when the analysts dug in and looked at the numbers, they just didn't match up to the valuations. And sometimes an IPO is a way to pass your problems to the public while everybody cashes out. I am not a big fan of investing in IPOs because you don't really know what a company looks like based on its filings, especially with some of the backdoor ways you can IPO now. You really want to look at 2 or 3, maybe even 4 quarterly earnings reports to really see how a company manages its business, manages its money before you even think about investing.
Yeah, certainly. Appreciate that, Daniel. I almost called you Devin because Devin's off today. Appreciate that. Really interesting, really different angles today. That going back to the health information, I'm still a little leery about that, but I guess, I just have no control over it. So what am I going to do? I guess we'll just have to wait, see, and trust a little bit, but also be vigilant, right, Dan?
Yeah, and I think there's going to be some space, and there probably already are companies that are working on this, where protecting data but also making it usable in an aggregate way, I think that's going to become a layer of security the way they're layering on security with banking transactions and some of the other things. So we'll get there, but our hunger for some of this outpaces our technical ability to deal with it.
Yeah. Well, Dan Klein, always a pleasure talking with you. Appreciate you so much for coming on the network earlier in the week and also on the podcast. And we'll talk to you again twice. So have a great weekend. We'll talk to you soon.
Talk to you next week.
Bye, bud. Welcome back, and now we're going to shift gears. We're joined on the line with Kevin Kelly. He is the co-founder of Delphi Digital, a cryptocurrency research firm. Kevin, how are you?
Doing great, Jeff. How about yourself?
Yeah, I know you're battling a little cold, but we thank you so much for appearing on the podcast this week. Not easy to do and balance work responsibilities. So what I'd like to do in this segment, normally we would have our market segment only, but Oliver Rennick's not available today. He's actually traveling out east, I think, to visit family. But what I'd like to do is start off with markets. So split our time, start off with markets, go a little bit longer today, and then talk about cryptocurrency. And I know you were on the network a couple weeks ago. We talked about the global update on crypto. but I want to do a lot more because this is an ever evolving asset class. So let's start off. How do you see the events of the market this week?
Yeah, so I mean, traditional markets right now, you're certainly getting to again like this very interesting inflection point where you have risk assets like the S&P 500. Your traditional equity markets, kind of soaring to all-time highs. You still haven't seen a confirmation in some of the smaller cap names, but they are actually. Some of the fundamentals are improving slightly. So you're starting to see a bit of more of a risk-on rally here. And that's also showing up in some of the riskier sides of the equity market, like international or emerging market stocks. So what's really interesting is you've seen, a pretty drastic pivot from, what we were talking about even just a few months ago in terms of this kind of doom and gloom, looking at the economic data that was coming in, and basically consensus was that the recession was not only inevitable, but also incoming and a lot closer than most people probably would have expected. And so we talked about this, I think, when Oliver was on. Him and I had both gone back and forth on this because we hadn't seen a trade that was had such an extreme consensus to it, and that everyone was buying gold, treasuries, more kind of fixed income products, and we're really kind of trying to stay away from these risk assets. And so what you've seen, fast forward to today, you've seen a complete kind of reversal in that trade where people have been dumping those safe havens, really getting into risk assets like stocks. And so I think, in the short run, that is a bit sustainable, especially as we kind of head into year end. I mean, you can't discount what happened heading into, December and the holiday season last year when you had one of the worst quarters for the S&P 500, in decades. But, I certainly think it is sustainable in the short term, but longer term, we talk about these longer term kind of growth catalysts. It is a bit difficult to try and pair where the S&P is trading today and just broader equity markets and what the outlook is for earnings heading into next year, right? Unless you get a really big kind of revamp or positive upgrades or revisions to the earnings outlook for equities, I think it's going to be a bit tough for the market to sustain these levels. Just because, again, you're starting to see, multiple earnings multiples and things like that expand. And it's not really a fundamentally driven rally, if that makes sense.
Yeah, absolutely. I think it makes a lot of sense. I want to ask you, Kevin, about trade. It looks like some of the trade dispute, even though it's not official, it looks like some of that has been wrapped up. Does that kind of recalibrate the market? I mean, as we've talked about on the show, and I don't think this is anything new for the audience, there's been a lot of negative talk. The market has been obviously pricing in some of these earnings, but also concern about trade, specifically with China. Does the resolution or the potential of a resolution does this kind of really turn things around and free I guess people to worry about other things during the remainder of the quarter?
Yeah, I mean, it's a great question, and I think in the near term, again, it's interesting because this year has really been marked by changes in trade rhetoric and sentiment, right? So the moment the market even gets whiff or wind of some type of agreement, even if it's just this phase one type agreement that's being worked through right now and getting close to finalized, so we hear, but there's also a number of things that we're also seeing potentially holding this up, but it's neither here nor there. The broad takeaway is anytime the market gets even a whiff of a potential trade deal, you see again this risk on rally. People dump safe havens, they get out of treasuries and gold, they go into assets like stocks. And I think what's interesting is that's a bit almost kind of short termism, because I think there are a number of potential headwinds, from a global economic slowdown standpoint as we head into 2020, that the trade war won't necessarily entirely make go away, right? For lack of a better word. And so when you look at what the potential impediments to growth will be, I think, the trade war is certainly something that's been top of mind for a lot of investors, but there are going to be a number of industries that I think are going to be pretty scarred from this. The relationship between U.S. and China, it's not like one day we come to a trade agreement and then the next day, everyone's buddy-buddy. I mean, there's definitely going to be some intangible damage to that relationship done moving forward as well. And the other thing that's kind of the trickle down effect that I think isn't really being too discounted as well is when you look out at our other allies and trading partners. If the U.S. is willing to do this and go toe to toe with it's easily its largest kind of competitor for global financial market dominance in China. What is that to say about some of our other allies that are either in smaller nations or smaller regions, right? So I think the U.S.-China trade war, even if it ended today, is going to have some long-standing effects in terms of not only just globalization, but also kind of the way in which the world views the U.S. And our position.
Yeah, and I would think also Brexit, because those are deals that have to be negotiated if and when it occurs. I want to ask you another issue, and we don't talk politics on the show. We're not going to talk politics on the show, but obviously there's something significant going on in Washington, D.C. with hearings. And how does the market, just in your estimation, is that the next quote-unquote crisis that the market thinks about? Does that have an impact? Because, we had trade. There's been a lot of negativity, people saying about the market, the economy. We've raised interest rates, we've lowered interest rates, we've lowered them, all that kind of stuff. How does a political event get factored in to what is otherwise an analytical process?
Yeah, so interestingly enough, I mean, to be honest, obviously, keep pace with the political landscape, especially here in the U.S. with everything going on, as you mentioned. But to be quite frank, the markets don't really, bat much of an eye when it comes to some of these things. And again, it might just be the fact that we're jaded after, several years of, President Trump not only being in office, or I should say a couple of years of President Trump being in office, but also kind of going through, a number of these, I'll call them ups and downs to put it lightly, but I think the market just gets a bit jaded to it. And to be honest, as you get closer and closer to this 2020 election, and obviously it's not, a shoo-in for anybody, I think that's much more where the market's trying to discount and still, quite frankly, hasn't really discounted what the potential effects of 2020, the 2020 election will be. The short-term, impeachment hearings that are going on right now, again, very, very important and very interesting and relevant information or events going on. But the market itself isn't really, batting an eye because, again, it likely wouldn't have any really substantial change to long-term growth or long-term earnings, things of that nature, right? The more kind of fundamental aspects that the market trades on over longer time periods. So, I hate to say that it doesn't really matter, but when it comes to kind of just a pure market standpoint, a lot of it's more noise than anything.
Okay, yeah, that makes a lot of sense, and that's actually good news because we don't want those issues, though they're important and need to be considered, we don't want them to kind of bleed over. What I hate to see is the negativity roll up into some other event that comes up and damage the market, especially going into the quarter. And I know I have literally no control. We have no control, but how this stuff can pop up and really damage a lot of things that are probably not intended. Kevin, what about, we're approaching year end. I want to talk a little bit about retail before we move into cryptocurrency, if you wouldn't mind. We're coming to a holiday season. Obviously, this is big for organizations like Amazon, Target, Walmart, countless other retailers. What are things that just the layperson should be kind of thinking about or looking at when you're thinking about the retail environment? Because that is, just based on our previous conversations and conversations on this podcast in general with other contributors, that's a concern. That is a shrinking environment. That is a shrinking sector.
Mm-hmm. No, I mean, absolutely. I think when it comes to, this specific holiday season, if you rewind the clocks again to what happened last year, right around this time, right around, last year's holiday season, and tying back in, the markets, I mean, because there is so much wealth that's tied up in, financial markets, equities, bonds, what have you. I think that since this year has been such a great year for investors, again, part of it is on the piggybacking off of such a poor ending to last year. But regardless, it is interesting as you see the kind of the correlation between, how the S&P 500 does, for example, compared to the holiday or retail sales on a quarterly or monthly basis. It is a pretty tight correlation, especially as you head into the holiday season. So again, assuming the markets even just stayed flat from here on out, I don't think you'd see a huge negative surprise or surprise to the downside when it comes to retail sales data.
Mm-hmm.
But the longer term trend, I mean, you're certainly spot on, and it's interesting. You are starting to see, Amazon obviously is an absolute behemoth when it comes to the kind of online e-commerce industry. But you are starting to see companies like Walmart, right, which is probably one of the better examples, starting to take away a little bit of bits and pieces of that market share and are finding ways in which to survive and even thrive under the, or I guess you'd say in the shadow of, the giant that is Amazon. So I would say retail is again, largely dependent obviously on kind of the wealth effect and how people are feeling. Obviously, we haven't gotten into a recession, but there has been a ton of recessionary talk this entire year, right? So the idea that people may be cutting back on spending just because they anticipate something that could potentially cause an economic downturn in the next, let's call it, 12, 18 months, that could certainly play into it. But I don't think we're going to see anything too concerning, at least this time around, just given where kind of the markets are trading and kind of the renewed optimism and consumer confidence. I mean, is near, at least in the U.S. here, it's near historic highs. So that I think will kind of carry the retail sector through year end.
Great. Let's shift gears. I want to go into your wheelhouse now, and I think the other thing's your wheelhouse too, because you were an equity strategist with Bloomberg, but now you are, just for the audience's benefit, and I think they know you very well, is your focus is on cryptocurrency. So let's talk about crypto a lot. This is a ever evolving market, and that's why we're covering this. This is a cutting edge show, and we're going to talk about cutting edge asset classes. What can you tell us this week on crypto?
Yeah, so we actually, our team, Delphi Digital, we actually sponsored an Oppenheimer event, the Disruption and Innovation Summit out in San Francisco earlier this week. And a large part of that was, as you can probably imagine, pretty blockchain and crypto and digital asset focused. And so what's interesting, I mean, you haven't had a ton of this week's been relatively quiet kind of on the crypto front in terms of, prices and where the market stands. But it was a really interesting, we had some really interesting panel discussions and conversations at the event. And again, with Oppenheimer kind of, backing it, there was a much more kind of institutional type crowd. And so what really kind of reassured us was that, the crowd this year versus, let's say, 2 years ago when you had that whole 2017 ICO boom and the Ethereum run up and all of that, this crowd is much more sophisticated, definitely have more institutions coming in, and the quality of just the questions and the conversations were really, really, I think, kind of moving or had the potential to move the ball forward. And what I mean by that is we as investors, research analysts, people that are in this space, again, from a more institutional mindset, it seems like this market is becoming a lot more skeptical to some of these projects. They have to be able to deliver on, the products that or services or networks that they're claiming that they're going to be building with all of this funding. And so the market's starting to really kind of separate, the wheat from the chaff, so to speak. And so some of the big takeaways, really quickly from this week, institutional allocations to crypto continue to grow. I mean, we had a number of different crypto fund managers and CEOs on stage talking about, their conversations with institutions. We had Tom Jessup, who's head of Fidelity Digital Assets, give a keynote where he talked about everything that Fidelity is doing in terms of rolling out custody execution products, what more legitimate data providers there are out there, and the conversations, again, they're having with institutions. And so it seems like this, regardless of where prices stand, this market's moving forward, and you're certainly going to continue to see institutions come into it, which I think was kind of a nice reassuring take, just given, the volatility of the crypto markets recently. And sometimes it feels like, we're beating a dead horse and we really aren't seeing that mass adoption that everyone's looking for. But then when you kind of take a step back at a conference like this and hear from guys like that, like I said, certainly gives us reassurance that long term, this is certainly an asset class we believe in.
So going back to our conversation, thanks for that, Kevin. Going back to our previous conversation about the markets, I've been doing a lot of reading, obviously, when I'm parsing through and building our newsletter every day. I saw a story about a U.S. recession could fuel a new cryptocurrency boom and bust. Any thoughts about that? Just dovetailing into our previous conversation, not that we're anticipating a recession, but a lot of people are still talking about it. Could that actually create a pivot and a change that would fuel a boom for crypto?
It's funny you asked that because that was actually one of the hotly debated topic areas of the conference itself too. It came up on multiple panels. What would happen essentially to Bitcoin and the broader crypto space, but we'll focus on Bitcoin because it is really kind of the most, I guess you could say, macro instrument out of all of them. And what would happen to it if a recession occurs? I sit in the camp where I think if you get a financial meltdown, right, which is obviously a lot more dramatic and drastic than just a shallow recession. I think if you get like a real meltdown, I mean, correlations among pretty much every asset class rise to one, right? As people just sell what they can, not necessarily sell what they want to. So in that type of situation, I definitely don't think Bitcoin and crypto escape that. I think, Bitcoin and crypto, the crypto market would take a pretty sizable hit along with not only just risk assets, but, even safe havens like gold, treasuries, is again, people just kind of try and find liquidity wherever they can. If we have a more kind of shallow or what we call like a technical recession where technically speaking, it's 2 straight quarters of contracting growth, but, things, or I guess you'd say parts of the market are still showing signs of optimism, and it's not like the consumer is really rolled over. I think if it's a shallow type recession and it's even sparked by a little bit more inflation, a little inflationary pressure, I think that actually could be a pretty big catalyst for crypto moving forward. Because again, that whole idea of broad-based currency devaluation and inflation hedges, that's really kind of a couple pillars that Bitcoin, the argument for Bitcoin long term, stands on. So I think it depends on what type of recession we get, but if it's not nearly as bad as some people are projecting, then I think it could certainly set up Bitcoin and crypto for their next leg higher.
I like talking about what also is going on around the globe. I saw a story early in the week that China, which I know we've talked about on this program and as well as our network program, that China is actually now rewarding. They're getting very big in the blockchain and crypto. I think there's some concern by many in the State Department and intelligence sources about their move into crypto and what the impact could be to the U.S. and globally. But they're now rewarding soldiers, I guess, that have performed well with cryptocurrency bonuses. Any thoughts about that? And then also we've talked about Venezuela, we've talked about Iran, and some other I don't want to say bad actors, but some of them are bad actors or bad economies or trouble politically. Any thoughts about that move?
Yeah, I mean, what's interesting too about that whole dynamic is when you look at kind of bad actors or people that want to use something like Bitcoin or crypto in a malicious way, right? Which again, going back to the kind of one of the fundamental, building blocks of crypto and the argument for it is that it is, Bitcoin specifically is censorship resistant, in that no one can really stop you from sending a transaction from, myself to you, for example, unless there was something actually, wrong with the transaction itself and kind of the source code behind it. There isn't anything that can stop people from doing that, right? Which makes it censorship resistant. You can't steal that. You can hold your wealth in a much more secure way. But at the same time, the flip side is obviously can be used for malicious purposes. I think the other notable point there is that when you think about the often on ramps for, because today nothing is priced in Bitcoin or any other cryptocurrency, right? You don't walk into the classic example of everyone talking about when can you buy your coffee or your Starbucks with Bitcoin. You don't walk into a Starbucks and have everything priced in US dollar and then also the Bitcoin alternative or equivalent. And I think that's going to be the trend for a very long time. I think Bitcoin will certainly serve as this kind of store of value, but I don't think from a transactional standpoint it's going to be something that our prices are really quoted in. And the reason I bring that up is because when you think about the on ramps and off ramps of people getting exposure to Bitcoin, oftentimes that'll happen through these, whether it's centralized or decentralized exchanges. And so some of those are actually cracking down on KYC policies and trying to become a bit more above board and work with some of the regulators to actually not only be above board, but also potentially identify some of these malicious actors. And so again, you can hold Bitcoin and transfer Bitcoin and get paid in Bitcoin, but at the end of the day, there is going to be some type of transfer agent that goes on as well in order to pay for your common goods and services today or in any other economy. So there is a little bit more nuance to it, and it's not as straightforward as just using Bitcoin to fund whatever kind of we'll call them the bad actors that are out there, and their and whatever it is that they're doing. But I certainly think that it is. I mean, it's a concern, but it's not anything that you don't see with something like physical cash as well, right? So I think actually long-term Bitcoin can be a better alternative to cash and serve as digital cash, because it is at least to a large degree verifiable, and that you can look at the entire history of Bitcoin blockchain, all the transactions that have happened on it. And again, it's not necessarily anonymous, but at the same time, it definitely gives you a much better kind of paper trail than something like physical cash, right? Which again is largely untraceable today.
Yeah. Well, Kevin, we really went around the globe. I mean, I think we did that in about 20 minutes, and I hope the audience appreciates that. Kevin, you have a depth of knowledge that I think really lends itself well to educating myself and the audience on what's going on. So we appreciate you doing some extra duty, and Oliver owes you one, by the way. And
it's my pleasure.
Yeah, we appreciate having you on, and wish you the best for a great weekend. And we will probably talk to you again next week.
Sounds great.
Take care. Bye. Well, we're going to close things out as we always do with a visit from the legal eagles. And today we have one eagle. The other eagle has flown the coop or flown the nest. I'm not sure exactly what the right terminology is, but we're very pleased to have with us a principal from Groom Law Group, Kevin Walsh. Hey, Kev, how are you?
I'm doing well, Jeff, and it's always fun appearing on the podcast via audio, but I think it's more fun to appear on your morning show when we get to film those segments.
Yeah, I was going to make mention of that. I mean, Kevin, you're pulling double duty this week, but earlier in the week, you talked about two really important topics in e-delivery and also missing participants, both very vital aspects of today's retirement system to ensure that it has integrity and make sure that we squeeze out the cost element that really drives up cost. So really appreciate you doing that. I know you and your colleague David Levine are exceptionally busy with clients. I know you guys are traveling, literally traveling the country day to day, week to week. So we appreciate making time on the podcast as well.
Yeah, with David, it's a little bit like Carmen Sandiego. With the Where in the World is Carmen Sandiego.
Yeah.
I think this week it's been Where in the World is David Levine. But then just pivoting back to the shows this week, missing participants and e-delivery, they're really kind of two sides of the same coin to me. I mean, missing participants is figuring out how we get in touch with all these folks that we've managed to lose track of because we've had paper records and people move. Mm-hmm. And then e-delivery is really kind of a going forward, how do we stay in touch with people better and use kind of modern tools so we don't lose folks.
Yeah.
So there are two fun topics, and I'm sure we'll talk about them more in the future as the rule gets finalized on e-delivery and as guidance comes out on missing participants.
Yeah, and I really love the way that you are able to, you're so knowledgeable on all these topics, you and David. You're able to break it down so that anyone, including myself, can really understand without going into the minutia of the legal aspect, which isn't a bad thing. I mean, if you're in a room full of attorneys or committee members, they need to understand the minutia, but the way you're able to break it down so that people understand it and gives them some actionable items, like what's important is to make sure your email address is updated with your record keeper or your HR. Very important. So appreciate that. So a lot going on, outside of that in Washington, D.C., those issues in Washington, D.C. What do you have for us today on the pod?
So I think today we'll talk a little bit about the Secure Act, and then we'll talk a little bit about kind of privacy rules, because there was a big privacy development this week.
Yeah.
So if you don't mind, let's jump into Secure Act.
Yeah, please. Go ahead.
Do you want to provide our readers, our listeners, just a summary of where Secure was earlier this year?
You want me to do it, or do you want to do it? I
think
if
you want to take that, then I'll talk about what's happened this week.
Yeah, sure.
I think it's stalled out, essentially.
Yeah, basically. So what I know about it, and Kevin, correct me if I'm wrong, Secure Act is really the first really huge piece of retirement legislation, I would say, since EGTRA in 2000, or maybe the Pension Protection Act in 2006, has a lot of really positive changes to allow people to save for retirement. So it passed overwhelmingly in the House of Representatives. I want to say in May or June of this year. Kevin, correct me if I'm wrong. In May. Thank you.
417-3.
There you go. So that's a great score. It's almost like the Washington Nationals or the Washington Capitals, right, Kev? And it has now been stalled in the Senate, and I think there are really 3 senators who have put in I don't know what you call them legislatively, but put in concerns.
So they've basically put it in holds, and just kind of pivoting from there. I think you've taken us up to today.
Thank you.
And really kind of the 2 ways forward for this are, one, it can pass by unanimous consent, which takes basically no time. A senator walks to the floor, asks, I'd like to pass this by unanimous consent. If no one objects, you can get through the business in 5 minutes. The other way that it could pass really is it could kind of go through the normal floor process where you tend to have a fair amount of debate on the bill and you need to go through cloture on bills. And so as a standalone piece of legislation, it looks like it's not moving. So the other way that you could do it, which is kind of the same path as the second path, is that you attach this to a bigger bill. So what we've been talking about is that government funding runs out November 21st. So maybe attach it to the spending bill that'll keep it going then. The theory is that funding bill is likely to go through, I think, December 20th. So that's another chance to attach it. So everyone in the retirement space has kind of had their fingers crossed, their toes crossed, whatever they can cross, hoping that, Secure is going to get across the finish line by being attached to a must-pass bill. We've been saying the odds have been kind of dropping a little bit, and this past week, the update here is that Senator Cardin, and he's not kind of he's not one of the holds, and he's been a supporter of this. He said, that he's not sure that this is going to get done in 2019. So what we're seeing is that we're seeing more public indications from senators that they've become pessimistic that this is going to get done this year, and that's kind of unfortunate for advocates of the Secure Act. So I guess we'll be on to 2020 with a very similar topic to talk about. So the saga that began with RISA, which was kind of the prior name for Secure, will continue with Secure into next year.
And that's disappointing. I mean, I would just say, not that I speak for anybody but myself, but I think that's just disappointing because there's so many good provisions, in my opinion, in that bill. One, annuitization is something that the industry has. The deaccumulation aspect in a retirement plan, very important. It's a huge topic, Kevin, as you well know, because you speak on these topics more than I do. So that's very disappointing. And then the MEPs and the ability to, or multiple employer plans and the ability to help get more people saving for retirement, because small businesses don't have the ability to don't have the scale to opt for, a lot of them don't have the scale to opt for 401k plans. So it's just disappointing, but realizing that there are a lot of things going on in Washington, D.C. You mentioned funding. We're not going to talk about the hearings that are going on because but all those things take up the senators' times. All I can say is I'm disappointed that it won't get, that even one of the authors of the bill in Senator Cardin is disappointed. So,
well, and if the Senate ends up using floor time next January and February to hold a trial, I think that will just decrease the odds of stuff being done.
Yeah. And that's his thing. Yeah, I'm sorry. I was just going to say that just in my opinion, it's just a disappointing. Like, yes, I totally get that there are things that need to be taken care of and things in advance, but it just seems like some of the business it seems like Secure Act to me is like a check the box kind of thing. I realize that there are holds on, but I think those things can be worked out. And an example, and I'm sure there are other issues in other industries, whether it's cybersecurity, whether it's House Intelligence Committee or Senate Intelligence Committee, all those things can be worked out. So what can I say? So I certainly appreciate you weighing in on that, Kevin, and disappointed, but we'll keep abreast. Hopefully there'll be a Christmas or a holiday miracle.
Hopefully. And then I'm just going to touch on another thing that came out this week, and we'll probably talk more about it in future weeks, but we've talked about GDPR, which is Europe's privacy regulation, and it's this behemoth of a kind of regulation that applies when you're kind of using data related to persons who are in Europe. And there's been a lot of kind of speculation on how this would apply to U.S. benefit plans. So, if you have a retiree who moves to Europe, or you have an individual working in Europe who's a participant in your U.S. plan, or you have someone who's on vacation in Europe, how's it going to impact? And on November 12th, the European Union released final guidelines on the territorial scope. And these are pretty helpful. Now, a lot of this is going to be facts and circumstances in terms of determining whether they apply. But just as kind of the high level overview, which is that, you can be, GDPR can apply to you as an entity if you're established in the EU, if you are targeting goods and services at individuals in the EU, or if you're monitoring the behavior of individuals within the EU.
Mm-hmm.
So this guidance provided some clarity on how those things apply. For benefit plans, it's worth taking a closer look at this stuff.
And this is on the heels, I know we talked about this, I think, both on this show and BRN AM several weeks ago when you were on. There's also the California, and I'm going to get the acronym wrong, but I think the California Privacy Protection Act, or the Consumer...
You were so close.
I was
so close. It's the CCPA, the California Consumer Privacy Act.
Yeah, and go ahead.
And yeah, there are draft regulations that out now, and David and I will actually be flying out to California the first week of December to testify before the Attorney General's office to talk about how to make sure that we can protect individuals' privacy while still making sure that plans and wellness programs can provide the services that retirement savers expect.
And so it sounds like the European. I know very different bills, right? I mean, one's passed by the European Union. But from the layperson's point of view, my point of view, it's good to see these entities, whether it's California, whether it's European Union, try to tackle who owns what data and what happens if data should fall into the wrong hands, who's responsible. And it gives me, and it's another topic, right, Kevin, that you are talking with record keepers, asset managers, plan sponsors, consultants about, because they're all your clients. Not everyone's your client,
so
but you have different types of clients. It's
a huge topic, and I think you've there's two issues you raised, and I think it's worth breaking them apart a little bit.
Thanks.
And I know we're going long this week, but there's cybersecurity, which is, if data about someone falls into the wrong hands. And there, I think we're seeing a lot of activity on the regulation front, and also being taken by plans and service providers to try to protect information so that it doesn't fall into the wrong hands. And to me, there seems to be more consensus in that area. The other side is kind of data privacy, and that's kind of, is data an asset? If it is, who can use it? How can it be used? How can it be manipulated? And for that, my fear is that we're getting really ahead of ourselves here. If we don't have a really good understanding of how it can be used, if we don't have a good understanding of what kind of benefits we can get from it, and we start putting kind of limitations in place before we really understand how it's going to impact kind of the benefit ecosystem, I think there's a real risk that if we jump ahead and regulate here, or we try to have a consensus before we figured everything out, that we might make matters worse rather than better.
Yeah, let me ask you a question, and we don't discuss much before we go live on the podcast, but let me ask you a question. Google this week, I think, either purchased or is partnering with Ascension to share health data, and just wondering, get your thoughts about that. I mean, does that help work some of these issues out that you're talking about with people? Because a lot of the health data, employers are partnering with Ascension, and does this help on the side of benefit plans and retirement plans? Does this issue kind of raise that up as a discussion point?
So just anything, it heightens kind of data as a high priority or high profile issue. But it really cuts in a couple different directions. And just at a glance, I mean, on the one side, I think we all worry when big entities have access to what looks like personal medical information. Mm-hmm. On the other hand, we might be able to make a ton of medical advances if this information is more accessible. I think one of the great things of big data is that it allows kind of for us to come up with solutions that wouldn't otherwise be available to learn things quicker than would otherwise be learned. So there's pros and cons. So we need to keep that in mind if we limit use.
Yeah, absolutely. Well, Kevin, thanks. We went a little long today, but I think it's okay. These are important topics, and people listening to the podcast, listen to the shows. want to hear more about the legal aspects. I think it creates a lot of interest, creates a lot of discussion that people have either around the dinner table or in their committee rooms. So appreciate you coming on. Give our best to David. Thanks for making time this week for us, and wish you all the best in your travels next week. So enjoy the rest of your weekend.
Yeah, thanks for having me on, Jeff.
Take care.
Talk to you next week.
Bye.
Bye.
Well, that wraps up this episode of the BRN Sunday podcast. Don't forget to check out our show, BRN AM, first thing tomorrow morning, 8 a.m. Eastern Standard Time. And for all the news in retirement markets, technology, personal finance, and so much more, make sure you check out each daily edition of The Morning Pulse. Until next week, I'm Jeff Snyder. Enjoy the rest of your weekend, and we'll talk to you all very soon.